Wrap the month, October 2023. Same old story, deja vu all over again. August, September, October. It's going to sound the same. Let's jump into it. Month of October, more of the same. S&P 500 off 2.15%. Nasdaq Composite down 2.8%. Small caps down 6.4%. Not a good month for small caps. Really not a good month for anything, but especially small caps. Vanguard total bond market down 1.5%. S&P 500 cap weight down 2.15% for the month, and the continuing theme of our equal weight RSP just not having a good year, to say the least, off 4.14%. Vanguard dividend appreciation down 1.45% for the month. Small, as we discussed up top, small cap, Schwab small caps down 6.4%. Vanguard total international stock off 3.3%. International not helping out. International small caps down 5%. Short-term bond funds, hey, we have a fund that's up 0.03%, which is essentially flat. Total bond market 1.5% down, and the Vanguard total international bond off 0.17%. Okay, so let's see how we perform for the last 12 months. Chart number 2, our 12-month overview. S&P 500 is up 18.93% during the 12-month period. Nasdaq's up 21.5%. That gap is narrowing. It was much higher at one point. Schwab small caps 4.13%. Small caps up 4.13%, really lagging behind the larger companies, and the bond market almost off 1%. S&P 500 cap weight 18.93%. And here's the discrepancy. Our equal weight 8.63% versus 18.93%. Vanguard dividend appreciation doing its job, 15.63. Small cap, Schwab small caps only up 4.13. International stocks holding its own, doing well, 16.5. International small cap, 12.78. Vanguard short-term bond, 2.65 during the 12 months. Total bond market almost down 1%, and our international bonds up 2% during the 12-month time period. Year to date, S&P up 10.5%, Nasdaq up 22%. Small caps off 3%, down 3% for small caps, and the bond market is down 2.41% as of October 31st. S&P 500 up 10.5% year to date. Equal weight down 2.5% as of October. Again, it's a 12% swing. It's an issue. We are going to be addressing it. Most likely at the beginning of the year, we will be swapping out RSP for SPY. I want to give it the end of the year because typically the end of the year is stronger, and we're hoping for a bounce back to kind of make up some of that downside. But this will be a fund that we'll be looking to swap out. At least as of now, that's my thought for the beginning of the year. I want to give it the year, but we're going to probably be switching over to SPY so we don't have this discrepancy and we kind of have a more truer depiction of when we're comparing to the S&P 500. Vanguard dividend appreciation year to date, 2.33%. Schwab US small cap off negative 3.3%. International stocks 1.86%. International small cap down 2.26%. Short-term bond from Vanguard up 1.41%. Total bond market from Vanguard down 2.41%. Total international bonds 1.89% up. Let's look at the market breadth. As you would probably assume, the market breadth is down. It keeps deteriorating when you have 3 bad months in a row. That just kind of makes sense. So what we're seeing here is, we're seeing a breakdown of the technicals. The S&P 500 is trading below the 50-day moving average. It is now broken down and is trading below the 200-day moving average, which in and of itself is an indicator of a downward trend. When you look at relative strength, down in the 40s. The percentage of stocks above the 50-day is 20%. The percentage of stocks above the 200-day is only 31%. When we look at this compared to the beginning of the summer, we were up. The percentage of 200 days above the moving average at the beginning of the summer was up in the high 70s. We're down in the 30s. So yeah, we're having market breadth is down. Let's look at the NASDAQ. Same kind of story, not as bad. Broke through its 50-day, broke down below its 200-day and kind of finished above up on the 200-day. But again, it's a market breadth deterioration. We are seeing relative strength model here. We're in the 40s. At the beginning of the summer, we were even in overbought status, which means the market was kind of too heated, and then it comes down. So over 70 means overbought. You may be looking to take some profits. And under 30 means that, the market's oversold, maybe you're looking to get some buying opportunity. Percentage of NASDAQ stocks above its 50-day moving average is only 20%. Again, beginning of the summer, we were at high 60s. The percentage of stocks above the 200-day moving average, 20%. Same old story here. Look at value versus growth. Again, two different areas of the market. And same old story here. Growth is outperforming value. So for the month, the Russell 1000 value was off 3.58%, where the Russell 1000 growth was off 1.47%. So you can see the discrepancy there of that 2.15%. Offense versus defense. You've heard me talk about this before on our Wrap the Months. I'll go over it again real quickly. Offense versus defense. Consumer discretionary are things that people do not have to have, but they want to have. Staples are things that people have to have, like toilet paper and paper goods and paper towels and things of that sort. So typically in different market environments or in a downward trending market, staples tend to do better than discretionary. And in growing stronger markets, discretionary tends to outperform staples. So for the month of October, that definitely held true. Staples outperformed discretionary by a negative 4.18%. So staples outperformed discretionary. As you can see here, consumer staples was off 1.39% for the month versus 5.52% for discretionary. Consumer sentiment. Yes, our wonderful University of Michigan consumer sentiment. And as you can guess, consumer sentiment is trending down. It went from 71.6% to 63.8%. So we are at 63.8% on consumer sentiment. Makes sense, right? The inverted yield curve. Oh, I love this chart. Our inverted yield curve. The inverted yield curve is lessening. The gap is not as wide. As you can see here, back in August, there was an inversion of almost 1. Now we have an inversion of 0.4. So it's still inverted, but the gap is not as wide, which means that the difference between what the 10-year is paying and the 2-year is paying has closened. The 10-year and the 2-year are becoming closer together to kind of get back to a normal range and eventually have the 10-year yielding more than what the 2-year is. And as you can see here, the 10-year Treasury is yielding 4.49, where the 2-year Treasury is yielding 4.93. It's really the same story for the 10-year versus the 3-month. The 10-year is yielding 4.49, while the 3-month is yielding 5.54. Well, there you have it in 11 charts, October 2023. As of this recording, November is shaping up to be better. So hopefully, when we get on this in December, I'll have good news instead of bad. Till next time, see ya.